Let me also bring in my next guest now. Sandeep Raina joins me. He's the Executive Vice President and Research for Nuvama Professionals Client Group. Thanks so much, Sandeep, for giving us your time and speaking with us. Let's get a sense of how are you looking at the markets. We were discussing this before. Are we likely to expect, now that we are at this all-time high levels, are we likely to see more consolidation, more correction, or 20,000 shouldn't post these earnings? That is something that could take us towards 20,000.
Right. Thank you. See, market is looking good. I don't think so anybody in the stream can say the market is not looking good. The only thing is from here, what needs to be done? Now, see, we need to understand that in last 3-4 months, we have taken a rally of 3,000 points in Nifty, which is around 20-22%. Now, from here, can we see a 500-600 points correction? I won't be surprised. Can we, break 20,000 on the upside? Possibly, yes, given the fact that, the results are reasonable. Banks have done very well. Reliance result was okay, which is these two are big portions of Nifty. Coming to IT, yes, the numbers were not good, but I don't think so downside is there, because if you look at company like Infosys, TCS, I don't think so there is major downside left from here on, maybe 5-7% more. So given the fact that where we are, I don't see there can be a big correction, maybe 19,000, 19,500 can come in. But this is a time that you look for mid caps, which are growing at 20-25%. There are many, there are ample number of stocks. And this is the best time to actually get into stock because, the results are out. And results will be coming soon for many, many companies. So that is the time, look for companies which are doing well, the commentary is very good, and then buy those companies also.
So, Sandeep, would you suggest that one should be looking at the mid caps and those broader indices at this point rather than looking at the main blue chip ones, or they should wait, and what should the strategy really be like?
I think I always go for mid cap because, in large cap, generally, these are compounding companies. I never see that large cap will grow 50% unless there's a deep correction happen in the market. Generally, large caps will give you a good compounding 22%. But one more fact is that the downside will be limited, in large caps. But I always prefer mid cap because in mid cap story, you can make more returns. And we have to look for company. Basically, we have to follow 2-3 roles. One, can these companies be cash flow positive? Is there a moat around? Can these companies grow at 20-odd%? Is there any corporate governance issue? If these 4-5 things are there, I think mid cap is something we should always look for, and they will make more returns. And there are many right now. Like there are few sectors like capex driven sectors doing very well. Mid cap banking doing very well, more better than the large cap banking. In fact, mid cap IT is doing far better than the large cap IT. So I'm saying mid cap is the flavor, and we should go for those.
Right, Sandeep, let's look at the broader picture now. Look at a couple of factors that could really impact. We are seeing, terrible rainfall across the country. This El Nino effect also perhaps taking over. Is that really going to come into play when it comes to your consumer discretionary inflation numbers, even though they have come down now? We've seen skyrocketing food prices. So how is that going to really play? And are we going to see that then trickle down to those macro indicators as well?
See, these kind of events actually gives you time correction sometimes or price correction. Now, I am not too worried on these things because this is something which is known to the market already. So inflation will be high going forward. We all know that. There are floods across the country and in many parts in North India. We are aware of that. And market understand that and digests the news very, very fast. So maybe this can give you some correction of maybe 2-3%, 4% max. But then we have to look for, I'm saying we have to play positive. The way to play positive, look for companies which have fallen and which should not fall, or the huge impact is not there, right? Maybe a quarter will go away, but then the next 2 quarters will again come back and the EPS will improve further. So I'm saying that is the way we should play right now, rather than looking for the, problems that we have in the market. Problems will give you some correction, then you have to buy. That is the way I will play.
Right, Sandeep, what about your take on the IT sector? Yes, we've been seeing them down and about, but if we have to look at the Fed, we have the FOMC meet, which will kick off today, and we are likely to hear Chairman Powell, come Friday morning. But what is the sense? They took that pause, and now maybe another 25 basis point hike is what everyone is already anticipating or factoring in. could that have implications here back home, and what are they likely to be? Which are the sectors that we could see? Would IT, would it be banking? Which are the sectors that one should be cautious about because of this fact?
See, whatever Fed does, like 25 is because they have been talking about in last 20, days. You will see in the press that, now they don't want to take a pause. They will do a 25 bips increase. I don't know what they'll do. Let's say if they do 25%, all 25 bips also, nothing much will impact. There may be a small correction. That's about it. And it's not that they will increase 1% from here in next 1 year. Nothing like that will happen, right? Because they're already at the peak of their interest rate cycle. So I'm not worried on that. That will just give me a small correction. Now coming to these events just give you short-term correction, but nothing will happen to my IT sector or my consumer sector in India or my capex-driven sectors, because we are going full throttle for capex, both in the private and public space. So nothing will happen to these companies, right? So I am not worried. I am not worried at all. I think these are just noise that we should just read and forget it about it. So unless he says I'll do it 1% over the next 6 months or 8 months, then I'm worried. For 25 bips, frankly, I'm not worried.
Right. Are there any other headwinds that one should be looking out for, rather the tailwinds then that could actually drive this market further ahead? What is your view on them?
See, in totality, as you discussed, there are few points that you should look at both on the positive and negative side. Coming to negative, what you said, monsoon, yes, Fed, yes. Most important, I think, which is, for any fundamental analyst, it's important what the market commentary is there, what the managements are saying. It's very important we listen to all the con calls. What are the management saying? I think that is most important takeaway. If you ask me next 15, 20 days, I will do, and as an analyst, everyone does, that what is the commentary, and then also do a lot of channel checks. What is happening in the market? Is it happening that what we are thinking of being bullish or bearish being happening or not? So if those things are correct and we are doing it well, I don't think so we should be worried across this thing, and we should be accordingly buying or exiting or reducing position based on the commentary and the feedback from the ground.
Right. Well, Sandeep Raina there, thanks so much for giving us all of those insights into how one should be looking at the markets right now. But yes, like he was pointing out, the next few days should be concentrated on earnings and the commentary that we're getting from management. And you should be coming right here to Moneycontrol to be getting all of those updates of all of these big earnings that are trickling in. Well, with that, it's a wrap on this edition of Opening Bell. We will be back with the same place, same time tomorrow with more details of how the markets are going to go ahead. But from everyone putting this show together, thanks so much for tuning in.